I am incredibly pleased to have with us today Ellen Meade. This is actually, the timing is wonderful because we're sort of following on from Loretta, who spoke about obviously similar things, and you were both at the coalface, if I can use that expression, of the industry that was the last Fed review. But since then, we have had a number of interesting developments in the world on the issue of fighting inflation. And we currently have the ECB doing a strategic review. We have the US Fed doing a strategic review. And we've had the Bernanke review and the Bank of England thinking about how to respond to that. All while we also have the issue of, monetary policy in different countries, perhaps looking a little bit more decoupled than it maybe did for a long time in the last 15 years. So, not to set you up to talk about too much, but we'll dip into all of those topics. But it's a real pleasure to have you here, Ellen. I won't tell the audience how long ago you and I met because it will carbon date both of us. Um, but I can remember the first time I came across your name was because of the Meade and Stavicic voice descent data, which I can tell you we still use to this day in some of our research. So, and I remember Chris Crow was your RA on some of that work, and he ended up having the cubicle next to me in LSE when I went there for the PhD. So, huge pleasure. Great to have you. Looking forward to hearing what you say. Normal rules will apply. If people have questions from the floor, there is a Q&A box. So if you put your questions in there, I will interrupt at appropriate moments to get the questions across. And other than that, Ellen, do you want to share your slides and we'll kick off and
Yeah,
have you
I
share
will
the
do that.
prepared remarks that you want?
Yes. All right. Hopefully you're seeing them.
They're coming up now. Yep, there they are.
Great. And thank you so much for having me. I am thrilled to be part. This is, of course, very timely because we expect the framework review results to be announced at Jackson Hole in August. And I'm fortunate to follow on from Loretta so that I can at least build on or expand on some of the things that she talked about as well. As you mentioned, Michael, I'm going to turn just to my first slide. I had spent the early part of my career at the Fed, and I returned in 2011. I actually returned the week of the 3% meeting when they put in calendar forward guidance. So it was a pretty big time. 2011 was a big year on a number of fronts. And I left the Fed at the end of August 21. So after, the framework review, and I had been Rich Clarida's special advisor, and doing review things with him. So I sat in the front row for all the things that were part of the 2019-2020 review. So the review, when it was announced, it said it's a review of monetary policy strategy, tools, and communications practices. That's still the same definition of the review today. What I'm going to do is take these a little bit out of order. Okay, so where by monetary policy strategy, what we mean is that statement that the FOMC issues on longer run goals and monetary policy strategy. It's called lovingly the consensus statement. So that's how I'm going to refer to it. It's also worth knowing that, your seminars about central bank communications, the entire review is an exercise in communications. There's the statement, the strategy statement. If you say anything about tools, you're talking about tools. And of course, communications are part of it. I'm going to talk about all three of these not in the order that they're listed when they talk about the review. First, I'm going to dispense with tools because there's not much going on there. Then I'm going to turn to communications, which I think is maybe the hottest topic at the moment, and then come back to the strategy statement at the end. So in tools, the original consensus statement, this is my second bullet there, was issued in 2012. There was nothing about tools in that original statement. In the 2020 statement, though, there were two comments. One was that the primary means of adjusting the stance of monetary policy was via the target range for the federal funds rate. This is something that the committee had been declaring in other documents, so it wasn't new. It was new in the consensus statement, but it wasn't news. Also, with that second thing, the committee's prepared to use its full range of tools. That was also not a new phrase. What was kind of new is that we were, I think, affirming that forward guidance and quantitative easing were not unconventional tools anymore. They were seen as part of the full range of the toolbox. That had been something that Chair Powell had been emphasizing from the time he took over in 2018. And will the 25 review take up policy tools? No. I mean, there's no information in the minutes in any of the remarks that have been made by Chair Powell at press conferences or at the recent Laubach conference. Tools never enters the discussion. But there are some issues around tools. You know, it would be nice to see the FOMC address these issues. I just don't think it will be in this 2025 review. And what are those issues? I think it's clarifying what they see as the proper or appropriate use of LSAPs or quantitative easing. You know, in particular, distinguishing between QE used in market functioning purposes, as it was in the first few months of the pandemic, and QE used for macro purposes, as it was in QE 2, 3, so on after the GFC, and also as QE became after the pandemic. Because remember, they start buying associated with the pandemic in March of 2020, and they continue all the way up until very late 2021. So they're doing it for a long time. Actually, up to 22, they start tapering in 21. Sorry.
No,
Yeah.
can I just ask on that? Because I guess one thing, I know the Fed has this increasing financial stability discussion as part of its meetings. You know, obviously I've done a lot of work with the transcripts, and if you go a long way back, you know, I guess around the peso crisis and the Asian financial crisis, these things would be discussed, but really as market operations and whether or not to open swap lines. Whereas now there is every second meeting, I can't, on the agenda, it's listed as, I always think it's quite funny. So this is something like an opportunity for the committee to comment on financial stability issues.
Yeah. What that means is it's not a go round, right? A go round would mean everyone gets called on, and an opportunity to comment, you can kind of raise your hand and get on the list.
But in this QE for market functioning versus macro purposes, do you think in terms of objectives that there should be a formal financial stability objective alongside the monetary dual mandate goals?
Isn't that a different question than around discussing QE for market functioning versus macro? You're saying whether they should more or less formalize the role that the Fed plays in market functioning.
Yeah, I guess. Well, I guess we've seen different deployments in different central banks. The Bank of England has a formal financial stability area, a committee, and there's clearly market operations that are serving a financial stability purpose. The ECB, I guess I view that as we had this language about market function as a way to circumvent potential challenges to using QE for, you know, this language about we need to ensure that the functioning monetary transmission mechanism. And I guess the Fed is somewhere closer to that than the Bank of England. And I wondered if you'd feelings that formalizing it was useful.
So I would think that the problem with enunciating it more formally is that people tend to stick fairly closely to the language in the Federal Reserve Act and the goals as stated in the Federal Reserve Act. So you wouldn't want to elevate it to a goal variable, but they always acknowledge they have a responsibility for it. So I mean, it's kind of a fine distinction. I just think that there was a bit of muddling in the summer of 2020 around when are we done? Do we think financial markets are now functioning properly? And so everything we're buying is now related to macro stabilization. There was a lot of, I remember it being discussed in the building, what's the right way to transition, and I think they could use some more formal conversations around that. I do think my personal view is hindsight's always 2020, that QE went on too long in the pandemic round, especially given the size and responsive fiscal policy, that there could have been market functioning QE, and then it's time to put the QE away. I think would have been my view. Of course, if you wound back to 2020, you wouldn't, be so inclined to see it that way. But
Okay,
I think, go ahead.
yeah, I was gonna say, but that's sort of what you mean then about this distinction and clarifying in the review, uh, a more a more institutionalized recognition that this distinction needs to be made at times.
Yes, why are you doing it, right? So more having a conversation around the usefulness of clarifying and always being clear about why you're doing it. Um, and that relates to this costs and benefits. They had back in the GFC, post GFC QE rounds, they always had costs and benefits in there. It's not clear they ever really had much of a conversation around that, but they could afford to flesh that out a little bit more. How much is too much? And also the use of forward guidance, because as we remember in December 2020, they had, and I quoted from the FOMC statement at that meeting, they put in forward guidance around the QE, which made it clear, it's substantial further progress. Those are my highlighting in italics towards the goals. And that ended up being somewhat problematic because it wasn't clear how to define that, right? And then also, they have this tradition from the post GFC period of tapering the purchases down to zero before lifting off with the federal funds rate target. And, the timing of pandemic inflation didn't permit the same timing that had happened after the GFC, and put them into, got them off the ground a little late. I think people like Randy Quarles have said, they really should have possibly lifted off in September, right, of 21. And to do that, they would have had to taper. They would have had to be comfortable maybe with tapering continuing while they were lifting the funds rate. These are things they haven't addressed, and it would be helpful to see them addressed. They don't have to do it in the framework review, but I wouldn't mind seeing them do it sooner rather than later. So I put these issues out there because I think they're going to remain unaddressed. Now let me go to communications, and we may spend, I think, a fair amount of time on this one. So there's a lot of energy right now, obviously, around the role of forecasts and alternative scenarios. And I think there was even some energy around it before Bernanke's review of the Bank of England, but boy, did that kick off a lot. Bernanke gave a paper at the recent Laubach conference. That was the conference for the framework review. That paper is very, very nicely articulated, a proposal in it. It's worth watching the video, reading the paper, watching the comments from Bill English, who's the former head of the Monetary Affairs Division. The group of 30, I think the week or two before, in the context of the IMF meetings, released a report on the Fed's framework review. And Bill Dudley has written columns in Bloomberg about this. Both of these reports call for the Fed to release the board staff's forecast, which is called the Teal Book forecast. Anybody who's poked around in those historical documents of the FOMC knows that it's the Teal Book forecast. Specifically, it's Book A that they're talking about, where the macro forecast is laid out. Book A also contains a risk and uncertainty section that lay out alternative simulations. So this seems to be the kind of proposal that they're making, although I will say there are, the devil's in the details, and some of the details I'd like to see addressed aren't in those proposals, and I want to talk a little bit about that. But why are they suggesting this for the Fed? Well, the Fed has been unable to, there was a, sort of a year-long process in 2012 to try to get a consensus forecast, get the FOMC to come to agreement on a consensus forecast, which I think probably would have replaced the SEP, but that exercise failed. It's fascinating to read about in the transcripts. A lot of it was around how do you disagree with that forecast? If you don't totally agree, do you dissent? And then you write a sentence or two that says why you dissented. Or could I do something in between agreeing and dissenting and lodge a reservation? And so now you can imagine 19 people, a third of them agree, a third lodge reservation, a third dissent, and then we've got sentences from all the dissenters and reservers. And boy, is that a consensus forecast? Is that really giving us an idea of where they are? And I don't think they weren't really talking about this same sort of idea that you have at the Bank of England of sort of best collective judgment. That's a broad umbrella, right? And so that failed. It's worth pointing out that at the time, Jim Bullard said, okay, well, this has failed. Let's just publish the Tealbook forecast. So that idea has been out there for some time. And so what I want to talk about a little bit is what exactly we mean by that. What could fly? And then a second related question is, would you give up the SEP? Bernanke said at the Laubach conference he didn't particularly care if the SEP stayed around or not. But I could imagine a number of policymakers would care. So then what do you do? And if you have the SEP in its current form, maybe you link those forecasts together so you can see individual reaction function idea without knowing, what would that look like? And would you also want a staff forecast? Would they be competing with each other? What are the pros and cons around that? But the idea that the Bernankean group of 30 have is that then you can use that baseline to run your alternative simulations and you can put out details as other central banks do.
Just because I think it's a super interesting discussion. I mean, as you note, the UK the Bank of England is having to consider some of these issues, but sort of from a different starting point. And I should make clear to the audience, I have no inside knowledge of where they're going to end up, but things being discussed are almost the same. I'm old enough to remember when the Bank of England's best collective judgment also included a special box in the inflation report where members could, lodge their alternate assumptions that they would feel more comfortable with. Maybe the best collective judgment is the inflation is transitory, but somebody really wants to lodge that they believe actually they think it's persistent and therefore this is what it means. As you say, I think these can be useful to communicate reaction functions because it's not just that you and I might disagree on the economics, we might fully agree on the reaction function, or we could agree on the economics, but have a very different view of how much we need to move rates in order to stabilize at some desirable goal consistent level. So I am interested now to sort of hear a bit more about this, and we can talk more about this issue of what staff can do, right? Will the staff do the same job? What does it mean when the staff, like you say, compete for optimal policy paths with policymakers themselves? It's kind of raises some interesting communication issues.
Absolutely. Okay, so let me talk about my main concerns here. And they're really around the conditioning assumptions. What we have in the Tealbook now is that staff picks a policy rule, and that sets the federal funds rate path over the horizon of the forecast, which is a 3-year-ish, it's the SEP horizon. And before the 2020 framework was announced, staff was using an inertial Taylor 99 rule. I actually pulled that rule out of the December 2018 Tealbook. From the monetary policy strategies section. I don't know personally whether there was a slight difference in the rule that was used in the model that they were running, but I doubt it. And so it's an inertial rule. And those are the standard weights. This was associated with Yellen at one point, I think called the balanced approach rule. Or people know it as the balanced approach rule. Sometimes it was called Taylor 99, so on and so forth. Um, then I put down another rule there, not because I believe that's what the staff is using in the Teal Book now. That balance approach shortfalls rule is one that now appears in the monetary policy report every February and July in the box on policy rules that we started writing in 2017. There was so much inquiry from Capitol Hill and some interest among certain members of Congress to have the Fed follow a rule. And it was getting a lot of attention, and it seemed appropriate for the Fed to, make some comments about what it means to use policy rules, because as you know from looking at the Teal books, they are presented with outcomes from policy rules at every meeting, right? A stable of policy rules. So anyway, this is the balanced approach shortfalls rule that exists in the monetary policy report today. Just note it's not inertial. If they use this in Teal Book, it would be inertial. And it's also, when we did stuff in the NPR, we used Okun's law and converted everything from output gaps into unemployment gaps because the Fed's goals are stated in terms of maximum employment, not in terms of growth. So that just gives you an idea. There is a rule out there that's a shortfalls rule. Once the committee moved to endorsing a shortfalls approach on the maximum employment side, I imagine staff switched over to something that looks, that's suggested by this. Okay. So, but what would be the right way to do this? You certainly don't want the staff picking the path for monetary policy, just picking it out of the hat. A rule is a systematic, objective approach, but then again, it's not a rule that necessarily has been endorsed by the committee. And why would we think that a baseline forecast that's premised on something where the committee hasn't weighed in is going to tell the public about what policy would look like? So it seems to me you have to have some synergy or interaction over the monetary policy conditioning assumption. And once you do that, it's not really the forecast that the staff is currently publishing in the Teal Book. Okay, so let's move on, because we have other assumptions in the Teal Book too, like how do you treat tariffs? And you've heard some from Chair Powell and, about baseline assumptions versus alternative simulations. But this is an interesting question, right? Do you leave tariffs completely out of a baseline and just run a bunch of alternative simulations with them in? These are choices that get made. At what point do you become so concerned about tariffs, or the likelihood seems so high that you make a baseline assumption around them and then still have alternative simulations? But these are choices that the staff routinely makes. So let's think about fiscal policy, which is another one, and I think quite different from what the Bank of England staff does. The Fed staff makes its own assumptions about fiscal policy, right? It looks at the discussions in Congress. Of course, if something is very close to being passed, or obviously has been passed, it's in the forecast. But what about something that seems like it has a good chance? In December 2016, we had an election. Donald Trump had been elected, but was not yet inaugurated. The staff put a Tax Cut and Job Act placeholder. It wasn't called that, but he'd been campaigning on tax cuts. They put this in the baseline forecast in December 2016. Now, that's a judgment call. You could have not put it in and run simulations around it. Would they have felt so comfortable putting it in if they knew the staff forecast was going to be released? Would the policymakers have felt similarly comfortable? What would the chair say? I think these are thorny questions. I think, in the US, if we said that they were just going to take the fiscal policy assumption of the government, which they've never done, would that be of the more independent Congressional Budget Office? I would hope so, as opposed to the administration. But then there are interest rate assumptions in those forecasts too. So it's a very complicated issue, I think, that potentially exposes the staff to a lot of thorny political exposure, you know. I think you would have to have, I could easily see you coming out where the FOMC has some role in selecting the policy rule that's used in the baseline, where there is some agreed guideline around fiscal policy assumptions. And I imagine they might be a little more conservative than what staff sometimes do now. Would all of this then ultimately require any endorsement, best collective judgment, sort of approval stamp from the FOMC? Obviously, the more you get that, the more the public could take that baseline forecast seriously. So I think these are all pretty important central issues. I think the staff at the Fed can't talk publicly about this, but I myself think, oh, how likely would it be then that the head of the Research and Statistics Division, who is kind of the main person guiding through this process, gets called before Congress to talk about the staff forecast. And in the US, I think we have a so much more politicized discussion around the Fed than, not that I spend a lot of time watching parliamentary hearings in Britain, but I think it's such a fraught time politically. I worry about regarding this as an objective document or objective forecast generated by experts.
I mean, I guess one question, maybe it's a question, maybe it's a comment. How often will these be controversial? I can imagine they'll be controversial on some occasions. Like you say, a president's just been elected, Donald Trump in the example you gave, but any president's been elected, especially if it's a change in party, and you suddenly know that there's going to be some new policies. You're going to have to take a guess of exactly what they'll look like from what was campaigned. The purist in me says the objective of the forecast is to provide the most likely outcome for the evolution of the economy. And that requires the most likely outcome for some of the input variables, including fiscal. So yeah, it makes sense that we have a view. I understand the politics around it on occasion could get messy, as they did actually. You rightly pointed out that the UK approach has traditionally always been to take the approved and signed into legislation policy of His Majesty's government and not to diverge from that, at least in the central case. But there were occasions, for instance, around Brexit, where the decisions made and the scenarios explored themselves became more political, I guess, than we traditionally have in the discussions over here. Is this a place where scenarios become useful? I mean, maybe I'm being naive, but I can imagine a world where you have a central case that's public that has a scenario of tariffs or a scenario of a different fiscal policy path. But internally, everybody puts their weight on the scenario version because they think it's the most likely. But at least officially, you have both. Is that a solution? That's kind of a communication solution, maybe.
It might be. I mean, what does that really make? Then you're kind of engineering the one that you publish, right? Or you're kind of thinking about that is that really the transparency? I just think it sort of has a bit of conflict there. Let me actually get into one point that I forgot to mention that I think is relevant here. It goes to one of the things you said. So Bill English raised in his comments on the Bernanke paper about differences between the staff monetary policy assumption and the SEP. And Bernanke's comment was, oh, that doesn't really happen. But it did actually happen quite apparently if you go back to 2017 and 2018. So in the December 2018 Teal Book, the staff was still using this inertial policy rule that's listed there. In fact, that's the rule from that Teal Book. By the end of the forecast horizon, which I think was 2021, the staff's federal funds rate was 150 basis points higher than the SEP. So now, that's why the rule is important. That's why you also have to think in the context of thinking about this, what happens to the SEP? What happens when there's a difference between, maybe the SEP gets collected and the staff premises on the SEP path. The only thing wrong with that is the timing of them right now is that policymakers use the Teal Book forecast to think about their own forecast. So you kind of would have to have some iterative process, and it would be a little bit longer lasting than the current process. I think they could find their way around that, though.
So anybody in the audience who was at the Bank of England Watchers event in November last year will have heard Charlie Bean talk a little bit about this conflict, the same conflict. The Bank of England has traditionally done a market interest rate path, or at least recently. And of course, that brings up its own issues. Yes, it's public, and you're not saying what your policy would be, but their conditioning assumptions and their economic environment that gives rise to that path could diverge, right? And I thought, I have not done this test actually, I keep meaning to do it. It would be interesting to know what a policy rule would have said with the Bank of England forecast numbers versus the market path at any point in time. I would imagine lots of the time they look pretty close.
Mm-hmm.
But anytime they're not close, isn't that exactly when it becomes really useful to talk about why they're not close? Maybe it's exactly a point that the committee wants to be more or less aggressive, or they feel like there's a risk that they're trying to manage, and they get to communicate that. But most of the time, it doesn't matter at all because these things kind of look similar, and that would be true. Staff versus SEP probably look similar a lot of the time, and the market versus the SEP probably looks broadly similar a lot of the time. But I haven't done that. I haven't done that full comparison for the central banks.
I agree with you. I think there's probably more information for markets of the difference between the SEP path and the market path than there is from the staff path, right? And so then if, would you then want to enter, and I gather from the discussion, from Bernanke's discussion, both at the conference and in the Bank of England report, no one's talking about premising the staff's Teal Book forecast on a market path. It doesn't seem like that is, I don't know what's being discussed internally at the Fed, or if this is even being, I could see them announcing in August, we're going to start thinking about this hard. We're working on this. I find it hard to believe that in August they're going to say, oh, you know what, we're making the Teal Book public. I think they probably need more running room before. But I could see them announcing an initiative to really carefully assess this, because I think we are at a time where you need these alternative simulations. You need to be fleshing out the distribution of outcomes. It's just helpful for understanding your reaction function, for making sure markets understand the risks, and so on.
Yeah. Okay, sorry, I should let you carry on. Sorry.
Okay. Now I'm going to go to monetary policy strategy. There's a long history with how we got to that 2012 statement. If you haven't, there's a paper in the Cato Journal by Jeff Lacker. I think it was published in the summer of 2020. It was from their conference in the fall of 2019. And he does this sort of history of FOMC discussions of the inflation goal, what it should be, whether they should have one, and, sort of how they got where they eventually arrived in January 2012. It's quite a nice paper, but it's important to remember that, 2012, it just didn't appear out of nowhere, that this had been a topic, throughout the 1990s. There's some particularly interesting discussions in 95 and 96. There's some particularly interesting questioning around Bernanke's interest in inflation targeting at his confirmation hearing in late 2005, for anybody who's interested in pursuing those things. Then in 2011, I said before, 2011 was a really interesting year. They were starting to discuss this idea of having unemployment thresholds in the FOMC statement. So they wouldn't lift rates until unemployment was at least 6.5% or something like that. I mean, that's, it was sort of formulated that way when they eventually adopted it. But if you were going to give out a number for unemployment, but you hadn't yet given out a number for inflation, and yet inflation was the thing you really felt monetary policy could directly control, you needed to say something, right? And in early 2011, Charlie Plosser, who was the president of the Philadelphia Fed, started shopping a small document around to, I think it was 5 presidents originally, just as sort of getting their input. And it was really a document that articulated an inflation goal. It had nothing to do with maximum employment, but it was around inflation. And then it got circulated to the FOMC, and momentum started to build. I think there were lots of conversations going on through the year. Bernanke had reconstituted this subcommittee on communications, which in the Fed history has played quite a role from time to time. Yellen was its chair. Plosser, Charlie Evans, Sarah Bloom Raskin were on it. They were doing a lot of outreach with other policymakers about what a full-fledged document would look like. And then they have a big discussion in November of makeup strategies. And in that meeting, Bernanke calls for them to have a statement of principles, which miraculously they consider at the December meeting. I mean, they'd been working on the statement for a while. Both of those meetings are exceedingly interesting. There was a full-blown discussion of a draft of the statement in the December meeting that is absolutely fascinating. And then they issued the statement in January 2012. I want to come back to this point about process at the end. So that's how we got that first statement. And so what did it say? It's the first articulation of an inflation goal. It says inflation is primarily determined by monetary policy, but maximum employment is largely determined by non-monetary factors that affect the structure and dynamics of the labor market. That language is still in the 2020 statement. It would not be appropriate to specify a fixed goal for employment, but it did include the median longer run U star from the SEP. In the fall 2011 discussions, and subsequently, they always talked about this document as quasi-constitutional with a high hurdle for amendment, which in my mind, when in 2019, 2020, Chair Powell started saying every 5 years, to me, that created a conflict with that idea. I mean, you could still have a strategy that you review every 5 years, but that to me is very different from this quasi-constitutional notion, very broad, never changing document. Then between 2012 and 2020, you have the unemployment rate here in this green line falling. You have inflation this is 2 here, inflation core and headline hovering near 2, but mostly below, averaging below 2%. And this shows the SEP U star variable from 2012 up to 2018. This is from Powell's Jackson Hole speech in 2018, the one about the stars. So just illustrating that you have the FOMC as the black line, and then you have blue chip and CBO, and everybody's estimate of the natural rate is falling over that period. So, this should all be known to the audience. By now, between the 2012 and 2020, you have a lot of discussion of a lower neutral rate, implications for meeting the dual mandate goals, and exploration of strategies for getting up to 2%, lower for longer type strategies, including, starting in June 2016, consideration of a shortfalls rule. So policy wouldn't react to unemployment below U star, only above. And in that, if you look at the June 2016 strategies optimal control section with this shortfalls rule or loss function, it turns out that that's the one that is best at getting you to 2%, right? Not doubling the weight on the inflation goal. The shortfalls rule is the best one. So this idea of shortfalls is kind of percolating around out there, even before we get to 2019. And then, of course, this apparent flattening of the Phillips curve, which means you blow through U star, it could be less, would be less costly in terms of inflation. This is a quote here from later. This is from Chair Powell in the 2020 announcement of the new framework at Jackson Hole from that speech. We, of course, in 2019, 2020, incorporated this Fed Listens initiative. This was a new initiative leveraging all the community outreach that's done across the Federal Reserve System, but it was leveraged to hold events where policymakers listened to the panelists reflect on maximum employment and price stability, although we asked them questions in a more user-friendly fashion than that. We had a hard time getting them to talk about inflation because there wasn't any inflation. But we heard a lot about the strong labor market, generating jobs for people who hadn't found jobs readily, people without much education, people coming out of prison, people on the margins of the labor force. And as he said, a clear takeaway from these events was the importance of achieving and sustaining a strong job market, particularly for people from low and moderate income communities. So that's the mindset that they're taking as they write the consensus statement in 2020, right? That is reflected in the speech there. And just to go back to the Laubach conference, Carl Walsh gave the paper on inflation, and Ken Rogoff gave some very nice comments on that paper. And he emphasizes that mindset was important. Take yourself back. There's been so much criticism around fate and around shortfalls. Take yourself back to the place your head was in 2019 and 2020. And I think that's very much right in terms of the influence that had.
So just because I think it's a super interesting question. I think it's clearly one that's affected all the major central banks, and that is, do you think we have accidentally, but importantly, reinvigorated the world to understand the costs of inflation? I've certainly noticed with my teaching that, a lecture on inflation and me talking about the costs of inflation, I could almost see students glaze over. They'd never experienced any kind of disruptions of the sort I was describing. And yet in the UK, obviously, we went a little bit higher here than in the Euro area or in the US. But when inflation got above 10% here for a short period, my gosh, you could see they were thinking this is incredibly costly. And I mean, we have the work from people like Stephanie Stancheva, the survey work that seems to show people now appreciate the costs of inflation more. But I had to sort of rein them back in a little bit and explain, well, if you think this is bad, right, I'm going to have a couple of slides talking about hyperinflation. And that's where we think it really messes things up. But do you think that is, on balance, a good thing that society understands the costs of inflation and not just economists?
I do, actually. I think if you if you have complete inattention to something, then you're really very vulnerable. I teach a seminar class on inflation, and I find that students are really motivated around the topic today because, of course, they were out of school. They remember the costs going up. They have various memories that you can bring out that are really pandemic memories, but of course the inflation originated through that. I think, if you talk to many of them now, not with us, but elderly Germans who were around for the hyperinflation period, it was so formative for the way Germany views monetary policy and inflation. And maybe that was, because it was hyperinflation, was an extreme case. But I do think it's important. Now, where I thought you were going was um, whether whether the framework caused them to miss inflation. I do think that they had a mindset, and I think the mindset was this is what we came out of: low neutral rate, labor market conditions really looking good at the end of 2019. We have a U or a V or whatever shape the pandemic looks like, and we go right back to where we were. I think that was the mindset, and that was an unfortunate mindset. But I think there was, I don't know where the Fed, if the Fed is even going to pronounce on supply shocks versus demand shocks. Maybe last summer's Jackson Hole speech gave their view on that. But I think, what is it? More than half of inflation by many estimates is supply related, combined with hitting pumped up demand, right? And a shift from services to goods. So,
I mean, I wasn't going there with
okay.
this one, but I mean, we've obviously spoken before on this stuff, and actually, I don't know if you ever looked at the final version of my work with Anna, but and Hao Pang, we actually make your point and attribute it directly just to you, that is absolutely correct, which is there was nothing in the consensus statement that prevented them from reacting to the supply shock element of the inflation as it emerged. It's just, as you say, they had a mindset. They were, we do interpret the fate and the shortfalls approach as being really focused on this weak demand world that we could live in. And then interpreting all the data with those lenses on, you react in one way, whereas there's nothing constraining them in the new consensus statement. It's just they didn't choose to use any of the sort of reference to supply shocks or trade-offs that you would have to make use of. So
Yeah.
I do have views on that, but I think my views come from you, so I won't just regurgitate them back to you.
I wasn't going to go into that topic, and so I have a few more things on just the statement and changes and things. So I'll just keep on
Yeah,
going.
yeah.
So, I just want to point this first piece out, all through the 2019-2020 process, policymakers kept saying that this updated statement was going to be an evolution, not a revolution, but it really was a revolution, or at least it was received as a revolution. That sometimes has me reflecting on, what happens inside an organization. And I don't know if you call it groupthink, but you're all bringing yourselves along on the same, on the same train, and yet outside people are riding a different train. And so it can surprise you, I guess. So in this statement, the ordering of the goals as they were addressed in the statement was changed to reflect the Federal Reserve Act. I think some people don't like that because they feel that inflation should remain first because that's what the FOMC can control. And because if you want to go back to the Greenspan view of a sort of hierarchical, having price stability sets the stage for achieving maximum employment. But in very important ways, so the 2020 statement retained 2%, right? It doubled down on inflation expectations and the importance of longer run inflation expectations being anchored. It introduced flexible average inflation targeting in a formulation that I think was very difficult to interpret. First of all, it was asymmetric, but it didn't tell you directly that it was asymmetric. And you had to, once inflation hit, people started figuring that out. It used the term average, the idea that we're going to achieve 2, but if inflation's been running really low, we're looking to average inflation at 2 over time. There were other words very early on that were suggested. But average is what was really, what was deemed important. And it's an appropriate monetary way, and these italics are mine, will likely aim to achieve inflation moderately above 2% for some time. So there's a lot of wiggle room in there, a lot of undefined stuff. I did think going into it that averaging was going to cause them a problem because, of course, it begs the question, well, what's the period you're averaging over? And, so all of that happened, I think, but the framework statement that part of it became irrelevant fairly quickly, I think. Then there were other changes on the maximum employment side, but all the non-monetary factors and not appropriate to specify a fixed goal, all of that is still there. It was this change to shortfalls of employment from its maximum rather than deviations that had been in the 2012 statement. So now I've got a couple of quotes here from Chair Powell. So the first one is from the 2020 Jackson Hole speech when he was announcing the new framework. The change to shortfalls clarifies that employment can run at or above real-time estimates of its maximum without causing concern unless accompanied by signs of unwanted increases in inflation, okay, or the emergence of other risks, okay? So some people took that to mean that preemption was gone. They didn't really ever have a committee discussion of whether preemption was gone. I, for one, thought that signs of unwanted increases didn't have to mean inflation was with you. It could be signs, capacity constraints or other sorts of, economic indicators that pointed to tightness. But other people took it very much as a removal of preemption. Powell said at his opening remarks at the Laubach conference that changes to shortfalls was not a commitment to permanently forswear preemption or to ignore labor market tightness. And I think that's quite clear, but I do recall a press conference or two in the middle of 2021 where he said that preemption was not with them anymore. So it's kind of like a shifting of the risk balance, right? I mean, there was nothing in the late 90s that prevented Greenspan from deciding that the productivity boom meant that U-Star was falling and they weren't going to be preemptive, even though the staff and other policymakers wanted them to move. Okay, so there's nothing that keeps you from doing that. Just like here, there's nothing that keeps them from being preemptive if they want to, but you are, by introducing shortfalls, kind of changing where you tilt the balance, I think. And maybe this experience after the pandemic or with pandemic inflation makes them rethink that. They took estimates of U-Star out of the statement, really because of the repeated downward revisions, and characterize maximum employment as a broad-based and inclusive goal. And of course, that's gotten attacked a lot. The word inclusion, inclusive, any of the included words are now viewed as woke language and being sort of removed here and there all over documents and websites. I think you can make a case that, maximum employment it includes a lot of industries. It's broad and inclusive of industries, of states and locations in the United States, types of workers, education, income levels, race and other demographic information. But I don't think it has to mean that. I'm a little puzzled from the minutes of their discussions whether they would amend that language or not, or leave it. Okay, so what will they do? And this is just based on my assessment of the minutes have been pretty informative and Chair Powell's public statement. So they've already said 2% goal will be retained and it's not a focus. And I think that also means they wouldn't entertain a target range around 2%, which many people have suggested, and I think probably does deserve some attention at some point. Um, when that issue came up back at the previous review, part of the problem with adopting a range around 2% was then you sort of implicitly approved undershooting 2, and they'd been undershooting 2 for a long time, and they didn't want to send that message. And if you did it today, it would say, okay, being a little above is okay, and you haven't gotten back to 2 yet. So there's arguments against doing it now. They have said the current economic environment differs greatly from the period leading up to the earlier review. I haven't put these in quotes because I paraphrased in some cases or changed words, but that's one of the statements that was made, I think, in the January minutes. And that the monetary policy framework needs to be robust to a wide range of economic circumstances. And this sentiment is repeated over and over again. It was in Powell's Laubach conference remarks. It's been in all 3 sets of minutes on the framework review section. And of course, they reiterated that it's important to keep longer term expectations well anchored. I think they will keep the not directly measurable changing over time. That was I think they discussed the employment goal in March. That language appeared in the minutes, reiterating what's been in both the 2012 and 2020 statements, that they would reconsider the shortfalls language. That's what it said in March. It also said that low levels of aggregate demand and inflation were a different circumstance than high inflation and unemployment, where the goals conflict. And then they also said, and this is a direct quote, the strategy of flexible average inflation targeting has diminished benefits in an environment with a substantial risk of large inflationary shocks, or when ELB risks are less prominent. I would love to see them reword the stuff around the environment of the low neutral rate and trips to the ELB to be a subcase, to acknowledge that that could happen again, but it's not where we are now. And so we're not putting fate in our current framework, but I think they're going to remove it entirely. It was the 2020 framework. I've used the term too specific. Loretta, in your comment a month ago, said it was over-indexed. I think that's the same idea. This idea about the framework needing to be robust, which is another interesting term, right? Robust, but you're going to revise it every 5 years. And is that saying the 2020 framework sort of just went too deep into the weeds? I think, it's going to be interesting to see how they communicate around this. The Jackson Hole speech, I'm sure a lot of care and effort will be put into trying to explain the changes. So I expect it to look, when there's all is said and done, closer to the 2012 statement than to the current 2020 statement. And let me address one last issue. The FOMC is a large committee. Many disparate voices. They haven't had a sort of consensus process like the Bank of England for bringing them in, even with those disparate voices, and trying to get to something together. The chair is very powerful in the Fed setting, as could be said of any very large committee. And of course, the chair has the agenda power and manages when discussions get talked about, when things happen inside the committee. He approves topics that move forward in the subcommittee of communications, for instance, determines how the consensus statement is brokered or discussed. And, this Fed system you could think of with the board as a hub and then all the reserve banks as spokes. Of course, they all come to Washington and sit around a big table for the FOMC meetings, and they get to hear each other. But if the consensus statement is brokered as a chair to policymaker bilateral set of discussions, as it was in 2020, you miss out on that group discussion that you had so much of in 2011. I think that's important. I think the consensus statement, for instance, average might not have appeared in the 2020 statement if they'd had a fuller discussion of it. I don't know, but I think there was probably more buy-in from policymakers in 2012 around that statement than there was around the 2020 statement. And I'll leave it there.
Okay, fantastic. Well, so I know some people have to drop out at 4, but you got all the really important stuff covered in the first hour. We do sometimes stay a few minutes longer just if people have questions. So if people have questions, please put them in the Q&A, and I'm happy to pass them on. I have one comment and one question that I will use up at least some of our buffer time with. The comment is, and I know you know this, but I sort of will say it again, that at least the work that Anna and I were doing, I think there's two things that we take away, and it links to your point about, well, your point about too specific, or Loretta's point about over-indexed. We sort of talk about how the Fed seem to be focused on a particular world continuing, and that's the same comment. I guess the point that you didn't mention that I think is very important is that was a world that didn't seem to be as prominent in the minds of markets. So, you know, you mentioned groupthink as an idea, and I hate that term because it's kind of a nebulous term that could mean lots of different group behaviors. But I do think that if you look at the market data, the distribution of risks they saw on inflation, they had lived through the same inflation slightly under 2%. The forecasts were about the same as the Fed's, but they didn't put tail risk on sort of extra chat. If anything, the risk of being permanently below 2% was dropping over the period, which is almost the opposite of what the Fed was thinking.
Yes.
And I think that's an important aspect, especially because, you know, suddenly this came to prominence, or particular prominence. It had been in speeches. John Williams, of course, had spoken about it a great deal. And so it wasn't a surprise. It was well signposted that this was a thing on their mind. But then when fate came in, it came in with, as you referred to it, like they brought in averaging, but without any specification of what that meant, what period. And we sort of point out that then if you take the speeches for the sort of 6, 8, 9 months after the framework review, you had some members who were saying 3% for a year would be fine, 2 years might be okay. Others who said 2.25 would be what we mean by overshoot. And so, I mean, if I just put myself in the position, if I'm the market and I'm not worried about this world, now you tell me this is the most important world, but you won't tell me exactly how you're going to respond. I can see how that confuses or adds a kind of element of uncertainty into the mix. Okay, so that's the first comment. You can respond to that or not if you wish. Let me put the second one on the table because it sort of links. There is a big question now, and I'm asking this partly. I know there are some people in the audience from the Bank of England, and it's a big issue, I think, for them and for others. How you've experienced in the bank, outside the bank, watching, etc. How do you think central banks can best communicate uncertainty? So you can respond to my comment, and then you can take, you know, what could be 5 PhD theses worth of work about communicating uncertainty. But I'd love to get your views on it before we end this.
Let me just dive in on that one first. I'm pretty sympathetic to this idea. You know, a forecast is a story. Central banks need to be able to tell stories, and they need to be able to tell stories to the general public, but very importantly to the legislators or the government and to markets. And so those stories have to be pretty well defined, which is why there's some notion of a baseline forecast, right? And then the idea that you have these very important risks, which in the moment seem to be extraordinarily high. You know, I think it's very interesting that the Bank of Canada didn't have a central forecast, right? They just have I like that idea, you know, as a way of communicating, gee, now it's just really too difficult. And then you have detailed stories around those alternate scenarios. So you can tell different stories. what would be nice about that is then if they're all part of a process that agrees that this is how they're going to communicate, then you adopt the stories. And I think Bernanke said this either in the paper or in the presentation at the Law Conference or both. What's really good is they adopt them and they talk about them. So they're talking about the same stories, right? Maybe they're 3 stories or 4 stories, but they're talking about the same 3 or 4 stories. They're not talking about different interpretations of fate, you know? I think that could be helpful because there is, at least in the Fed speak, just too much communication going on. I don't think it's helpful for arriving at a central view. It might be helpful to each individual for getting his or her ideas out there and his or her reputation enhanced. But I don't think, and you know, I am concerned about that. I don't think the Fed communicates in a helpful way, in part because they don't have a sort of centralized agreement on how they should communicate. They might even resist that idea, right? But to go to your thing on fate, this is where I think, first of all, I do think in a consensus statement where you want broad support, sometimes you do end up with a bunch of words in there, you know, a lot of wiggle room, a lot of, you know, it's defined in the breach. But at the same time, I think if they had had a committee discussion of draft language, you would have found people focusing in on that construction and sort of saying, we don't like average. Maybe there's a different way to communicate that we're going to, you know, tolerate inflation being above 2 if we've had persistent misses below for a long time. And I don't know, I can't see that they would have ever gotten to a numerical representation of that, but maybe the language could have helped because there were too many open questions.
I mean, we are all products of our environment, and I started my career at the Bank of England. So, you know, the Bank of England has a point forecast for inflation, but it does have these bounds outside of which it then has to fully explain itself in a letter to to the government, to the chancellor. And so I actually, you know, and I know I've spoken to many people at the Fed and other places that disagree with this, but you know, I quite like that because I think it tells you that if your target is 2, 1.8 is not the end of the world, but nor is 2.5. You know, again, we should prefer 2 to 2.5, and we should prefer 2 to 1.5 or 1.8. But we shouldn't, because we can't, because of limitations on our optimal control policies, we can't get exactly the number all of the time, or even necessarily
Yes,
most of the time.
yes.
And so I'm very sympathetic to this, but I know I face a lot of objection to this, and I realize it is a product of starting my career at the bank and seeing that as the way they did things. It always seemed like a natural way of communicating that.
I do think, you know, given what we've been through with, I realize the Fed doesn't target our consumer price index, but that went over 9% and PCE went over 7, right? You know, for years having a lot of mishigas about missing 2% by getting 1.8 or something like that. It does bring things into perspective, as you were bringing up before,
uh,
and maybe raises the question of, you know, were they getting overly not recognizing exactly, you know, situations that really make you feel you need to act very
yeah.
strongly versus, you know.
Okay, I'm gonna end on one last question. We've had a very quiet audience, but if you look at the participants, I think they're all a bit too. There's a very powerful. If we weighted it by power in central banks and positions they've held or hold, I actually think it's very high powered. They're obviously not willing to reveal views on it with a question, even though I don't say who asked the question typically. But let me ask this one question. You can answer it in a yes or no. Fan charts as a method of communicating uncertainty. Yes or no, or maybe.
Well, we put fan charts in the SEP. The economist policymakers wanted them in the SEP. That's a very interesting discussion, actually. I think it was 2015 or something like that. when they have a discussion around putting fan charts in the SEP. And the people who weren't economists said, I don't really get this. Why do you need this? I mean, it encompasses such a wide range of outcomes. What is the information content here? That's why I think scenarios could be better. So I guess I'm not a fan of fan charts.
Okay, no, that's good. It's actually interesting. So I'm going to use this to plug some work I'm doing, but hasn't been done yet. With experimental work on how people interpret information in scenarios versus fan charts versus dots versus speedometers versus whatever. And we will be doing it, not just the experimental part will be done on the general public, but we are going to do some of the work also on central bankers, central bank watchers, journalists, etc. So many of you on this email list for this seminar, you may be getting an email from me saying if you want to spend 15 minutes and contribute to what we know on this. And I may find that you're exactly right, that the economists love them. I'm quite partial to them. I like them. But yeah, maybe you're right. Maybe they just have to be used in a way that we will never use them. And if we don't use them in that way, as you know, if you put the band so wide that they encompass any possible inflation rate from -2 to +10, what are we learning? Like maybe I guess the way we're thinking about it is this trade-off between you obfuscate the central case, but and pardon my colorful language describing it, but you dynamically cover your ass. So, when inflation turns out to be 4 and you said it would be 2, you say, well, 4 was in my range, so not my problem. That's the kind of trade-off we're thinking about, but we'll see. We'll see what the results come out
Well, it
with.
sounds like a really good thing to look into and study.
Yeah, everybody check your inbox. Anyway, Ellen, we are right by the time. I want to thank you again for your time. It was great. I think it's been a wonderful follow-up to what Loretta did. And as I said at the start, I know you, given your background and given your focus and attention, you think a lot about the Fed, but I think these same issues are turning up in other central banks and they won't stop turning up. So we can all look forward to maybe another conversation after the announcement of the Fed review. Maybe I'll get some of you back to have a round table and discuss what actually came out.
Oh, that sounds like fun. Thanks so much for having me.
Excellent. Thank you to all the audience. Keep your eyes on the next one. Carola Binder will be the next speaker, so we'll see you in about a month. But otherwise, thank you, Ellen, and everyone have a good day.
Bye.